Joining us now is Diane Swonk, KPMG chief economist. Diane, the markets are near record highs, but on the labor front, things may be stalling out. How dire a sign is this?
Well, we're still at very low unemployment rates, but what I worry about is under the hood. What we're seeing is a lot of inequality, and the economic aggregates are masking that inequality. The stress unemployment rate, that includes people working part-time instead of being able to find full-time jobs, those marginalized workers that are discouraged out there, that unemployment rate went to 8.1%, its highest rate since late 2021. We also saw the ranks of the long-term unemployed. People move from 15 to 26 weeks into 27 weeks or longer. Those ballooned to the highest levels since 2021 as well. And so that underlying weakness in the labor market, it really shows a labor market which is consistent with what we've seen in a lot of private sector data as well, one that is freezing up a bit, where those workers who have a job are frozen in place and those workers who want a job are frozen out.
Diane, so what does that mean we look for next to signal the impacts on the market and the longer-term direction of the economy? And my impression has been for the last couple of years, the solid jobs picture has propped up stretched credit. It's propped up rising rents. Consumers have been able to sort of get by, but these numbers concern me in the sense that maybe that period of labor backing up everything else could be drawing to a close.
Well, that certainly is the concern of doves at the Fed and some at the Federal Reserve. We will see a rate cut. The question is, will it be enough for us to not see a descent? And we could see descents in two directions, because there is a concern out there that, given the fact that we've not tamed the inflation that's gone on for more than 4 years now fully from the pandemic, at the same time that we have a tariff-induced bump in prices that is not just a one-time bump but sequential because of the way that tariffs were rolled out, that has sort of really split the Federal Reserve. So you've got doves arguing for at least a 0.5% or more cut at the next meeting, and hawks on the other side of it, likely to dissent for no cut whatsoever. And it really is a hard situation. It's one thing for the Federal Reserve to forecast a mild bout of stagflation, which they have since tariffs have come into the mix. It's another thing to live it in real time.
So would it be safe to say, as the market is pricing in, that a 25 basis point cut is basically a foregone conclusion for the rest of this month? And if so, how much now hinges on something like CPI, the inflation data we get next week? We get more labor data revisions next week as well. What would it take to constitute a larger cut and or more cuts behind this one?
Well, we do expect 3 cuts by the end of the year now, but I think to get a larger than a quarter point cut, you'd have to see a much cooler CPI, and I think we're going to see a hotter CPI. One of the things to watch very closely in the CPI is not only goods inflation, because that, again, it could just be a step up and, it's prolonged because of the uneven rollout of tariffs. That could dissipate over time. What we are watching very closely is the inequality out there. Affluent consumers are propping up service sector inflation, which accelerated last month. If that continues to accelerate, that's going to be very worrisome for the Fed, because that adds a new element to inflation that they thought would be an offset to inflation going forward. And so if we see a very hot inflation number, it's going to keep it to a quarter point, but there will be pushback and you could see dissents on both sides. If you see a cooler inflation number or not as bad as people expect, that could prompt the Fed to cut more aggressively and do a full 0.5%.